Fantastic, and thank you for that very generous introduction, Ethan. And welcome to IG clients. I understand that we have clients from right across the Asia-Pacific region, from Singapore and Malaysia and the Philippines, New Zealand, other parts of the world, and of course here in Australia. I'm coming to you live from Sydney, Australia. A little bit overcast here today, but otherwise quite a pleasant day. And once again, welcome to the presentation that we have ahead. Ethan mentioned my experience, but before we get to talk about that, we're just going to cover off on a couple of the important disclaimers that we need to mention. I know my colleague Daniel Dabrowski mentioned these, and thank you, Daniel, for a fantastic presentation on the luck of trading and risk management. It's always very important in my mind to keep risk management front and center in your trading. To me, it's one of the most important elements of trading. Nonetheless, CFDs are complex instruments. They are levered instruments. They carry a high risk. They magnify your gains, but can also magnify your losses. So it's very important to keep that in mind. They may not be suitable for everyone. And of course, this is a general disclosure. This is the presentation today is talking about general market commentary. It is general in nature. It is not specific to your needs. If you need financial advice, you should seek an independent financial advisor. Terrific, we've got that out of the way. Yeah, as Ethan mentioned, I have quite a lot of experience, a couple of decades now, and I have a great passion for financial markets. I really enjoy being involved. I enjoy the challenges. It's not without its challenges, but it's quite a fascinating sort of industry to be involved with. I started price making for a bank here in Australia, spot FX, options, forwards, swaps, all that kind of stuff, and then went to work for a portfolio as a portfolio manager for a big real money fund here in Australia, and managed their entire currency portfolio, several $1 billion worth, which is really interesting sort of organization to work for because we had a lot of different asset classes. I worked also as part of the global fixed interest team there, so managed bond portfolios, have managed equity portfolios as well, actively trading currencies, commodities, rates. And so I would really encourage you to ask me any sort of question. Hopefully I can answer it for you, but I'm always open to a discussion. So please feel free to ask any sort of questions that you may have along the way here. So moving along here, we're talking about central banks today because in my mind, what's happening at the Fed is driving the world. We certainly have pockets of nuances, and we'll talk about some of them today, but really what the Fed is doing is really driving markets. And it's important to understand where we've come from to get a handle on where we're going. So that's what we're going to be talking about today. And people who are familiar with my work would be, some of these concepts today are concepts I've talked about before, but they're unfolding in the way that we had anticipated to a large degree. Not always, obviously. No one is always correct, and that's an important component to remember about trading. You are never going to be 100% correct, and having that risk management, in the front and center is a really important thing to keep in mind. So some of the themes, identifying the decision-making process that the central banks go through and why they've done what they've done. Once we understand that, then we can get a handle on why they're doing what they're doing, and we can sort of try to prepare ourselves for that. We'll have a look at the policy shifts. We're already we're getting to the end of a big policy shift, but where that end is, we're not too sure. But let's have a look at a couple of maybe potential opportunities to make the most of those sort of shifts that are happening, and understanding the catalyst for change within market regimes, which we'll touch on just at the very end. And look, if we have time, I can go through some other markets, other currencies, or any kind of market that you'd like to have a little look at. I'm happy to put up a chart and talk through it. What I'm seeing may not be maybe worthwhile, may not be, but I'm open to discussion, that's for sure. So if we move along, why do central banks do what they're doing? They're raising rates, they're tightening policy. How do we get here? And the reason why they're tightening and the reason they're doing what they're doing is because they have this asymmetric bias. Central banks are prepared to let inflation go to try to stoke growth. And that makes sense, right? So they had this bias within their monetary policy framework to really encourage growth. And this works because we've learned from history that central banks can get inflation under control. It's a painful solution, but it can be dealt with. And it's called the Volcker solution because in the 1970s and into the 80s, I'm going to be talking mostly about the Fed today, just to make that clear, because obviously the Fed is the world's largest central bank and it's driving most markets today. So this is the Volcker solution. Paul Volcker was the chair at the Federal Reserve. He served under two different presidents, Carter and Reagan, and he had the full backing of both regimes from both sides of the aisle to do what he had to do to get inflation under control, because high and unstable price pressures create uncertainty. And when you have uncertainty, it's much harder to price for long-term big projects. So if you think about, say, a 20 or 30-year infrastructure project, how do you price that? Well, you price that off long-term bond rates. And if you have high and unstable inflation, those bond rates are uncertain. And then if you have uncertainty around pricing for long-term assets, that creates a risk premium. And that means that capital becomes more expensive to build the necessary infrastructure type of project. So it's the very big macro sort of things here. This is why inflation targeting is really important. This is why inflation has to be got under control. But central banks have let it go, and they've let it go on purpose because, as we know, the pandemic created a very, very uncertain environment. So central banks and governments around the world provided all this stimulus, and they threw everything at it because we know the problem with growth is that once that flame goes out, it's really hard to get back. But if we have inflation, central banks know how to deal with it, and they know how to deal with it because of the Volcker solution that came about in the early 1980s. And if you've been listening to the Fed quite a bit lately, it's hard not to if you're involved with markets, but one thing they have been reiterating, from the entire board, they are singing from the same song sheet, and that is they have to keep rates tight. Financial conditions must remain tight in order to get inflation down. It would be a mistake to start loosening policy before inflation is way down. So while there's been a lot of talk about a pivot, there's not a rate cut coming, in my opinion anyway, for the foreseeable future until inflation gets down. Once inflation gets down, then that changes the whole ballgame. But right now, inflation is still really high, as you can see in this chart here. And this is just the year-on-year inflation. And I just wanted to put this up because that white line is just that 1981 era where, let's have a quick look here. That's the Fed funds target rate. So look at where inflation was in the early 80s and look at where the Fed funds rate was. We've still got a way to go, right? This is not over. We've still got a way to go. So if you want to get inflation under control, conditions need to remain tight. And this is what's happening. The Fed is not backing away from this. They know an issue. They know what the issue is, and they're dealing with it. They're trying very hard. Markets seem to be ignoring it, or some markets in particular. The bond market is saying, we've got a problem ahead. Look, it's going to be an economic slowdown. And to what degree that slowdown will be, it's uncertain. But the bond market is saying that it's flashing warning lights. And we'll have a quick look here at Japan before we move on, because this is the growth side of that equation I was talking about with inflation. We talk about inflation, central banks can deal with it. If you stoke growth, then that's the bias within the central banks. And this is the reason why, because in Japan, they had a huge boom through the 80s, and in the early 90s, they had that day of reckoning, and the stimulus that came from the central bank, from the Bank of Japan, and from the government at the time, many studies have been done, and this is the reason why central banks bias towards stoking growth, because of what happened in Japan. Now, Japan has got a lot of other issues in terms of demographics and all sorts of other headwinds, structural headwinds, but nonetheless, all the studies that have been done is that growth wasn't stimulated quickly enough. There wasn't enough stimulation from the central banks and from the government to get growth going again. And that's why when we look at, say, the Nikkei 225 index here, just as a representative of the Japanese economy, it hasn't fully recovered. This is 32 years later, and it still hasn't recovered. So this is why central banks have this bias toward risking inflation in order to stoke growth. But of course, now we're in this era where the Fed now is just looking at inflation, and that's their focus, because we're over the pandemic. Well, we're not over it. There's still a problem in many parts of the world, and of course, China is still addressing their policy, but certainly in most parts of the world, the COVID policies have loosened, and we're moving on. And so now that we're doing that, the Fed is changing tack, obviously. They've been tightening aggressively, and what the Fed does impacts treasuries, impacts the US dollar. US dollar flows into the rest of the world. Equity markets are not listening to what the Fed is saying. The US dollar and treasury markets, they're listening, but equity markets right now, they're looking for a soft landing, which might be possible. That's certainly could happen, but it's certainly this week we heard from a whole lineup of commercial banks and investment banks out of the US, and they all pointed toward a potential recession for 2023 in the US. And that's the fact that they all came out on the same day. That is saying something. This was not by mistake. This was not a coincidence. All of those bankers from all the big banks in the US on the same day came out, and they all spoke about the problems for 2023. So, that's not a mistake. That's not, just coincidence. It's done on purpose, and there's a message in that. And I know from my experience and talking to a number of people at banks and some really good economists and analysts that work for banks, is that they see what's happening live. They see the bank accounts, they see what's happening, they see where people are spending, they see where people are saving. So for all the banks to come out at the same time and talk about a recession next year, they're seeing something, and we're not seeing that. We don't have access to their the books. But the fact that they've all come out and said something on the same day, it's something to really make sure that we keep on board, because that's not a coincidence. Anyway, looking at treasuries. Now, look, I just want to put this one up quickly because we need to understand, where rates are, what's going on. You can see the pandemic, that dipped down on the left, early 2020. We've since recovered and we've come a long way. We'll just zoom in a little bit further here, just have a closer look. And what's really interesting here is, see that blue line, that's the 1 year, the orange line is the 2 year, the pink line is the 10 year. And the gap between let's look at the 2s, 10s, because that's the most important one in my mind. It's certainly what the market focuses on. And we'll have a quick look at the 2s, 10s. And here it is here. And look at that. And do you know the last time it was at this level? It was in 1981. And what happened in 1981? The Fed had to get tough on inflation. And we're in this environment now. There were 2 recessions in the early 80s, and they were caused by this tightening. So, whether or not we have a recession, a technical recession, or whatever it is that we have to get inflation out of the system. The Fed knows this. Other central banks around the world, they're all fighting the same cause. We've got to get inflation down because of those reasons I mentioned earlier. If you have high, unstable price pressures, you cannot plan for the long term, or it becomes much more expensive. It's a drain on capital. It's a drain on productivity. So this is why the central banks are so focused on this. And the bond market here, the 2s, 10s, treasury curve, this gets the most focus. Other parts of the world, they look at different parts of the curve. 2s, 10s is the sort of benchmark generally, though, globally. Here in Australia, we've got 3s, 10s, but that's only because we have a futures contract for the 3-year bond, not the 2-year bond. So nonetheless, what that curve is telling us is that there's an economic slowdown happening soon. At some point, we don't know exactly when, we don't know how deep it will be. It might be shallow, hopefully it is. Hopefully inflation gets under control, we can go back to some kind of normality. But certainly the bond market is telling us something, and the bond market historically has been more accurate than the equity market. Of course, past performance is no guarantee of future performance, but nonetheless, this is what the bond market is telling us, and this is what all those bankers told us this week. And the Fed, every single board member on the Fed is talking about keeping rates tight, keeping financial conditions tight. And when equity markets rally, that's a problem for the Fed, because what that does is that loosens financial conditions, and that's the opposite of what they're trying to achieve. So when equity markets rally, people feel that they have more on their balance sheet, means they can spend more, they can pay more in prices, that creates CPI, and this is where that's that spiral that the Fed is trying to avoid. So there's a degree of frustration from the Fed, from what I've been reading and where I've heard the comments, is that equity markets aren't listening to what they're trying to do here. And this is what the bond market is listening, US dollars listening, the currency markets are listening, but the equity markets aren't. But that's not to say that there's not opportunities, and we'll get to something a little bit later on anyway. Now, talking about treasuries, I know this might get a little bit bogged down, but hopefully we get a really good handle on this, because this is what's driving, I think, a lot of markets. And I just use the 10-year here because it's the benchmark, but you can look at different parts of the curve and you get a similar type of picture here. Now, the break-even inflation rate, it's important to keep this in mind because this is a market-priced inflation rate. So it's derived out of the Treasury Inflation Protected Securities, or TIPS, and that is a market-priced inflation rate. And from that, we can get the real yield. And we're just looking at the 10-year here because this is the easiest one to look at. I look at a lot of different parts of the curve and they all have different sort of meanings, but this is the gives us the better big picture, I think. So we'll keep going here, because when we have a look at the real yield and look at the US dollar, well, it tracks pretty good, right? So this is what we're seeing here, and this is what's driving, I think, real yields are driving the US dollar, or there's certainly a significant correlation. It doesn't always hold. The correlations are unstable. If you've ever done some studies on correlations, they're never static. They do move, but it's about identifying, what markets are really in sort of lockstep. And while this isn't completely in lockstep, there is certainly an overarching theme here. And I think that's pretty easy to observe there. So that's all we're talking about with the real yields, US dollar. But when we move on and we have a look at dollar yen, we can see the impact there too. So this is a tradable, whereas like with the previous slide, we're on the DXY, which is actually tradable. It's certainly tradable on the IG platform, I believe, but it's less traded than say the dollar yen. So this is here we have the dollar yen, and you can see that yield spread. US Japan 10-year. Now the 10-year in Japan, of course, has been anchored at 25 basis points by the Bank of Japan. Now they are maintaining yield curve control. They're maintaining ultra loose monetary policy because they've still got issues around growth. They've got inflation ticking up. They're still not seeing the growth that they want to see, and they would actually like some inflation. The Bank of Japan, I think, would be quite happy with some inflation because it would help drive prices generally higher, which they haven't had for a long time. So look, you can just see here, this is once again, the correlation isn't exactly, no markets are exactly correlated to 100%, but certainly we can see the relationship here between the Treasury note and that yield spread because, what's happening in dollar yen, it's been, really, helped along by the return you get on Treasury bonds. And, Japan have a, very high savings ratio. So, the return is overseas. Does dictate a little bit about sentiment toward the yen or vice versa. So that's what's, that sort of picture. So this is why I'm talking about, the Fed a lot, because what the Fed does, it's talking about what Treasury market's going to do. It rolls into currencies. This is all ricocheting around the world, and it's a huge, titanic shift that's going on here with the US dollar and with policy coming out of the Fed. It's a pretty wild sort of time at the moment. Pretty much unprecedented. Interesting times for markets, that's for sure. And look, here we have the gold price, and you can see the correlations here too. So this is the DXY impacted by real yields, and gold in particular. Like, gold is not a yield-bearing asset. People go to gold for safe haven or perceptions of value. Certainly guys that I talk to who are in the gold market, and they talk about the industrial value of gold. Gold can be used for some industrial purposes, and they talk about, sort of, it's pretty rubbery, but around 300 or maybe 350 an ounce. And here we are here, sort of just under 2,000 an ounce there. So, there's a lot of value in the fiat part of gold price, but, it's a matter of what people are prepared to pay, and they're prepared to pay a lot more than what its industrial value is because of that perceived store of value that gold has. So anyway, the relationship there, you can see the real yield, that's what I had up before, DXY. Look at that inverse, that red line and the gold line, it's pretty tight there. And that's really been spun out of the real yield, in my opinion, anyway. I want to have a look at that. It's sort of, it fits a bit. I mean, gold's pretty volatile. It's not a neat fit, I wouldn't say the real yield, but it's certainly something that I look at quite a lot. And you can see just back, that symposium, that purple line there, just before that, gold price started breaking down just as the real yield started ticking up there. So, this is why I really try to focus on, what's going on, inflation in the US and what's going on in the Treasury market in the US, because it flows into all sorts of markets. And hopefully, I'm getting this message across because I think it's pretty important. If you're involved in markets, you just can't ignore what the Fed's doing, and provides potentially some opportunities. If we keep going here, a lot of people look at what the Fed is actually doing in terms of rates, but also this is one of my favorite indicators of what the Fed is doing and the impacts of what they're doing, because what this chart is like the title says, it's total reserves of depository institutions at the Fed. So that means all the financial institutions in the US, how much excess liquidity do they have on the balance sheet that they park at the Fed. And so that's what this chart is telling us. And you can see, we made that peak in the start of this year, and that's when equity markets made their peak. And of course, the Fed has been tightening. Financial institutions are drawing down on what they have at the Fed, and liquidity is being withdrawn from the system. So we have a look at the NASDAQ compared to that, and that's a pretty neat fit, isn't it? So, keeping an eye on what these guys do is really important. And this is my preferred indicator. As I mentioned, there's lots of different ways to look at the Fed balance sheet, but this is my preferred indicator because it's a bit more, unfortunately, it's not very timely. It only comes out once a quarter, so it's not the best, sort of market tool, but nonetheless, keeping this in mind, and the trend, I think, is the biggest thing here. And look, that liquidity, I can't see that ticking up. I think, it looks like the trend is sort of toward lower levels of, deposits by financial institutions at the Fed. So, that's just something to keep in mind here when we talk about a few other, potential sort of outcomes from the Fed. So if we move along here and have a look at the Dow Jones, the NASDAQ, because I think there's something really interesting going on here. And, about a month or so ago, I was looking at, you come in the mornings, you check out markets, what's moved, what hasn't moved, and I look for dislocations and what's moving, and then what else would normally move with that market and it hasn't moved. So I look at, obviously across the majors, you look at the dollar yen and euro and sterling and dollar Swiss, and if one of them moved a lot and the others haven't, you ask the question, why is that dislocation occurred? With the Dow, I started to notice it about a month ago. On the up days, the Dow seemed to have slightly better days than the Nasdaq, and on the down days, the Nasdaq seemed to go down more than the Dow. So I started to pick that up, and I looked into it a little bit more, and it comes back to what I've been talking about, really. This liquidity withdrawal out of the system, what are the impacts of that? Well, when you look at the Dow Jones is, made of the top 30 companies, pretty much in the world. I mean, it's in the US, but it's, 30 big companies. The Nasdaq 100, obviously tech-laden, and there's quite a few tech stocks in the Dow, like Apple and Microsoft, but they are very big tech, and they have very healthy balance sheets. When you look at the Nasdaq and what's in the Nasdaq, sure, they've got some big tech, but also they've got other tech companies that are vulnerable to a tightening of liquidity. And by that, what I mean is that when they fund their growth, how do they fund their growth? Because they've developed a really good product, they've got it to market, they've got some cash flow going, but they need to get sales going, they need to get distribution going. How do they do that? They go and borrow money. Either they raise some debt or they raise some fresh round of capital. And when liquidity's been withdrawn, that becomes much harder. And so this is what's going on here in my mind anyway. This is my theory around it. I could be wrong, of course, but what we're seeing here is the withdrawal of liquidity from the Fed. We've just been talking about, it's been illustrated, we know that's happening. Companies that are vulnerable to debt and equity markets, that is, they need to go to the market to raise more capital, they're a bit vulnerable, in my opinion, when liquidity is being withdrawn from the system. And this is what we're seeing. And that's why the Dow is outperforming the Nasdaq at the moment, in my opinion anyway. So we'll just have a quick look here, because once again, the real yield, you can see that inverse relationship. Yeah, it's not as tight as we thought, but there is a relationship there. But I want to get to the next chart, because this one's really interesting. And now this is the ratio between the Dow Jones and the Nasdaq. It's simply the Dow Jones divided by the Nasdaq. That's all it is. So this ratio, you can see there now it's at just under 2.9. Now it got down to 2.14 in November of last year. The long-term average, which we'll get to in a little while, is 5.3. And we're at 2.89. You can see there, that's the yellow line there, 2.89. So the long-term average 5.3 since 1995, long-term average 5.3. The 3 years before the pandemic, the average was 3.6. So we're still at 2.89. So liquidity being withdrawn, companies that are vulnerable to raising capital versus companies with big balance sheets that don't need to raise capital. Here we have the Dow Jones over the Nasdaq. Here's the ratio. This is what's going on. So really fascinating dynamic here. It's going to be really interesting to see how this plays out, because as I said, those weak balance sheets, there's an old saying that I think Warren Buffett coined originally, is that when the tide goes out, we get to see who's swimming naked, and the tide's going out. Liquidity's been withdrawn. What companies are vulnerable? Where are the holes in the system? And when liquidity's been withdrawn, I think we're going to find out. And this is where it's going to be quite an interesting little era, I think, over the next 12 months because of this tightening. And we haven't really felt it yet. Certainly, equity markets are not pricing in a slowdown. Earnings, forward estimate earnings are not pricing in a slowdown. So this is a really interesting dynamic. And so in my mind, this is a really interesting sort of perspective to be, if you want to be long down short NASDAQ to, be equity market neutral, but that ratio is there and it's 2.89. As I said, 3.6 for 3 years going into the pandemic, 5.3 the long-term average. But I mean, I'll get to the next chart just because it's really interesting. So this is the long-term Dow Jones in NASDAQ ratio. So when you look back, you can see what's going on here. The ratio got down as the tech boom happened into the late 90s, and then of course the tech wreck happened, and then the ratio got back up to, I mean, look at that, it's almost 10, so 9.5 was where it was back then. But then over time, that ratio has come down, and that makes sense to me because over time, these technology stocks, as we've seen over the last 20 years, the innovations and productivity gains from these companies has been absolutely phenomenal. We live in a really interesting age in that respect. This technology world that we live in now, didn't just happen by accident, it happened over time. And these companies in the NASDAQ, they outperformed because they had growth. They were able to fund their growth. And so that makes sense to me. That slow, well, it's not, I mean, there's a bit of volatility in there, but, that slow, from the top left to the bottom right, that grind lower makes sense because over the last 20 years, technology companies have done really well, while the bigger old school type companies in the Dow Jones, they just continue to play along, and obviously some great companies in there, but they didn't get the growth that you had in the NASDAQ. So that's why that ratio has gone the way that it has, and that makes sense. But now we're in this different environment, and that's what I'm just trying to say here is that this is something to keep an eye on, I think, because it could be an opportunity if you are into that sort of thing, but certainly keeping an eye on this is well worthwhile. So that's something to keep in mind. And look, I just wanted to talk here now. We've got a bit of time, so if there are any questions, please feel free to put them up there, and Ethan will obviously read them out. But one thing for trading wise that I certainly look at is what sort of environment are we in, and it's really important for me. And my colleague Daniel Drabowski in the previous presentation, he talked about risk management and how to apply that. And for me, understanding what regime that we're in helps me to determine my position sizing, my whole risk management framework. Certainly, I've worked for a couple of hedge funds, and when you're in a hedge fund, they give you a VAR allocation, a VAR-based allocation of capital. So that means a value at risk, which is determined by volatility at the time. So the higher volatility, basically, you reduce your position size, is what it equates to. So I've just really simplified this sort of regime system that I look at, just so that we can get a really good handle on it and how I look at markets generally. Now, I've read some really good research on regimes and how to identify them and what they look like. And one of the ones I think is from one of the investment banks. They come up with like 44 different regimes, but of course that's quite complicated, and that's for a macro portfolio across a multi-asset portfolio. So here we are. If you're just looking at trading, high, low volatility, trend or range, where are we now? So I would say, in my mind, we've made the high. I'm just talking about equities in general here because it's the easiest sort of market to talk about and talk to. We had that run up, and we've collapsed since the start of the year, and we've gone back into a range. So if we go back to the beginning of the pandemic, the headlines were terrible. It was an unknown world, and we didn't know what was going on. That was a really highly volatile trend. That first sell-off in equity markets, I'm talking about here again, that first sell-off in March and April in 2020, that was a trend because it was all just one-way traffic, really, and it was high volatility. So it was a high volatility trend, and that's why I have in the top right corner, because those sorts of markets can provide opportunities. Obviously, risk management, yes, crucial for identifying that, but certainly that high volatility trend that we had, that big crash. And then we got the response from the central banks, and then we had a high volatility in a range. There was about 3 or 4 months there, maybe 5 or 6 months, where it was really volatile, and we're getting big, moves overnight, 5 and 7% moves in some of the indexes, and then collapse the next day, and then rally again the next day, and it was just really highly volatile range trading. And then once we got through that period, we set up for a long 2-year trend, basically, and it was a bull market with all that liquidity coming from all the central banks, all the governments around the world, and that was a low volatility trend. And certainly, I know probably some people listening today identified that trend and were able to maximize those opportunities. But nonetheless, that was a low volatility trend that we've had up until recently. And what I think now, I think we're changing regimes again. I think we're more likely to be in a range type environment. Now it's fairly low volatility at the moment, but I do feel that it's a possibility that we could get back into a high volatility range type environment for trading. And I find those environments are really challenging. Other people really like range trading. I find range trading difficult, but I prefer trend markets. But everybody's trading is different, and everybody is unique in the way that they trade. And trading is a very personal thing. So the way that I trade is not going to be the same as anybody else's trading techniques. Now I've been around a while, so I've got a few different strategies that I deploy, and part of that is that in different regimes, I'll employ different strategies depending on where we are. So that's just identifying that regime. So I'm questioning now, are we in the low volatility range or in a higher volatility? I think we're somewhere in the middle right now. When you look at the volatility indexes, like the VIX for the S&P 500, or if you look at the MOVE index, which is the bond market, US bond market, what's fascinating is the VIX is, it's just above 20, hovering around there, been there for quite a while. But it's not really going anywhere, which is interesting, and I think that might change at some point. But what is happening is the MOVE index, which is the volatility index on the bond market, that's been ratcheting up, and it has been for quite a while now. And so, that tells us, I think that's the bond market again is saying something to us. I think that, I'm really trying to listen to the bond market at the moment rather than the equity market, because the bond market is sounding the alarm bell on quite a few fronts. I mentioned the 2s, 10s, and you look at the volatility in the bond market as well. But of course, bonds have had a rough year because of what's happening with their treasury yields, like I told you. So like that chart I had up earlier on, there's treasury yields have gone further north. That means the asset value of the bonds goes south. And so that's just a mathematical reality around bonds, and that explains part of that higher volatility in the bond market as well. And so, of course, now we're getting to the point where there's actually a return on 10-year bonds in the US and other parts of the world. So a year ago that wasn't the case, and so it was a really unknown world this time last year in terms of what bond markets would do. You hard to get a return on a bond. Now, you can, well, it depends on which part of the curve, which part of the credit curve. You can get out on the credit curve a little bit, get down to sort of the lower rungs of investment grade. You can see pretty good returns, yeah. So, that's a big change. So that means that you don't have to be in equities. You don't have to be in short duration cash. If you're getting those sorts of returns at the back end of the curve, well, investors, they'll start looking at that. And this is where I think, this is where this dynamic is changing, and this is what's going on in the world, and this is what's happening. That's why the bonds are becoming much more interesting, and that's why the yield curve is inverted so much, because at the short end, you've got the Fed tightening really aggressively, but at the back end, you've got investors going, actually, I don't mind a 10-year bond at, 4 and a bit percent or whatever it is. So, that's what's really going on there, and that's a big dynamic. So, just sort of keep that in mind. Ethan, do we have any questions there?
Hey Dan, yes, seeing one question right now. So once again, I want to urge all viewers, if you have any questions, right, just feel free to type in to the question box, and we can try to answer as many as we can. So firstly, we have this question for you from Feb. So he's asking if the high inflation this year will bring about a high base effect. I'm thinking he may be referring to inflation affecting equity indices. And his part 2 of his question is asking, does it mean it does not take a big fall in upcoming inflation? I may be thinking he's referring to a big fall in the interest rate hikes, so to bring down the interest rate. So do you have any views on this?
Yeah, that's a very interesting question. I think well, he certainly mentioned the base effect, and that has been getting a lot of airplay lately. And so I'll talk about the base effect to start with, and then see if he wants to talk about sort of interest rates and the flow on from that a little bit later on. But so the base effect is it's very real. It's a mathematical equation. The way that inflation is calculated in the US, it's a monthly CPI number, and it'll literally just staple 12 numbers together, and that gives you the annual rate. Now, of course, what happens is when you have the inflation rate that, say, for 1 month is very high, and that drops off, well, then you have that base effect falling off. The problem at the moment, though, is that the monthly reads, the last month was actually pretty good, so it actually eased off a little bit. So that was actually a good read. That's a good sign. But we'll come back to that in a little while. But so the base effect is real, but the numbers that are rolling off aren't that high to start with. I think there's a couple of 0.7s and 0.9s. I mean, they're high for a monthly number, but they're not, the 2.5s that we have seen previously. So that base effect is real, but it's not having the impact that it would. So this time last year, and this is where the Fed really got out of lockstep with what the market thought they should do, and that was that we saw an acceleration in inflation at this time last year. And they didn't tighten. They waited until this year before they tightened. And that's where the market, or certainly bond market, was looking at the Fed going, you're making a policy mistake here. And the Fed, they've got a lot of very good research at the Fed. And one of the issues that they were dealing with was this base effect. And then once they realized the numbers were rolling out, so they actually, to go back further, just to sort of reiterate where we are here, that the high inflation numbers that they were getting initially around sort of March and April last year were the deflationary numbers that we saw from March and April in 2020. They were big negative numbers. And when they rolled out of the annual number, you got a big uptick in the inflation rate around sort of, May and June in 2021. So that base effect was real. I mean, that's just pure maths. So that's fine. That is a base effect. But the problem is in August and September and October, inflation continued to accelerate. So the monthly number kept accelerating, even though the base effect had been accounted for. And this is where the Fed made the policy error, in my opinion, and I'm not the only one. Many people felt that they made a policy error, and I'm pretty sure when you look at the Fed even acknowledged that Fed Chair Powell's actually looked back and said that they should have been tightening earlier. But that's another thing. So they talked about the base effect, and this is real. Now I'll keep talking about the base effect for a little while before we move on. But the base effect now is not as dramatic as it was then. It still will have an impact, and yes, that would be great if inflation can roll off a little bit. The problem in the US is the tight labor market, and the economic conditions there haven't tightened enough. And so this is what's really going on. And the other issue, the other problem for inflation and CPI in the US, it doesn't get a lot of airplay, but I think is very important, is how high PPI is. That is the producer price index, sorry. And that is still coming in really high. And that's a problem because companies at the factory gate or at the farm gate, they've got higher input costs. So what do they do with high input costs? Well, they've got two options. They can either pass on those increasing costs, and of course that pumps up CPI, and the Fed don't want that. So that's a problem. The alternative to passing those price increases on, the increase in costs, is to have margin compression. So that means that they'll take the hit themselves, and that's destructive to earnings. So if PPI stays high, that's a real problem for the equity market. It hasn't been addressed yet. The Fed they pass on their costs, PPI feeds into CPI, and then Fed have to keep tight for longer, tighter for longer, higher for longer, all this sort of talk that I'm sure everybody's heard about recently. That's the problem for the companies in the US at the moment, is PPI is still really high. Now, of course, there's a lot of factors that have gone into that. Inflation is, it's a big beast. Now, of course, it's demand and supply. And of course, supply has been impacted by the Russian invasion of Ukraine, and of course, the Chinese zero-case COVID-19 policy. So now these things are changing, and certainly in the last week, some of those supply issues hopefully can be eased up a little bit. But until they really ease up and PPI gets down, inflation's still a real problem. And part of that problem I just touched on was the tight labor market. And when you have entrenched inflation expectations, that's where it's a real problem. And I know in many parts of the world, a lot of wages are reset annually on what the inflation rate is. A lot of wage bargaining is based around what inflation is for pay rises. So the longer inflation stays high, the labor market stays really tight, and that keeps wage prices happening. And that problem there is that consumers continue to pay more for goods because they can afford it. And so that keeps CPI going higher. And that's the problem with entrenched inflation. And you'll hear central bankers all around the world talk about this. And so that's what they really want to try to get out of the system. And this is what we're talking about. This is the Volcker solution, is that if they've got to kick inflation out of the system, and it hurts. As I said, in the early 80s, they had 2 recessions. Technically, the US hasn't had a recession because they have a special department of the government that declares whether a recession has occurred or not. They did have 2 negative quarters of GDP growth, but they've had a positive one just recently. So, so that's a good thing. The world's biggest economy, it'd be good if they have positive growth. So that would be a positive. But certainly, what we're seeing with inflation is that it's entrenched inflation is the problem, and that's what the Fed's trying to deal with. Now, I'll just go back to the base effect from last year, because what happened was when that inflation acceleration was happening in around sort of July and August, September, into the 3rd and 4th quarter, is that the Fed pivoted from calling it a base effect to transitory. And so the modeling that they were doing at the Fed at the time, they thought the base effect has come through. Okay, that's all washed out now. There's no more base effect, but inflation's still really high and accelerating, and they called it transitory. And so that was a real problem. And they didn't deal with it at the time, and now they've had to tighten aggressively. Now they've front-loaded the tightening process, which is entirely appropriate because it gives them room to move, to cut down the track, which is what they're trying to be able to create, that opportunity to be able to provide liquidity back into the system if it's needed. But what they have to do first is get inflation down, and this is what they're dealing with: is this high, unstable prices that need to be addressed. And they're trying very hard now. The equity market doesn't seem to want to listen, but certainly the bond market is listening. And I think it's a challenging period going forward because of what inflation is doing, and that entrenched inflation, which is quite dangerous for central banks. So hopefully that answered your question. All right. I think there's another one there, is there, Ethan?
Yes, so we have a question from Anthony as well. So I think you were showing the ratio between Dow and Nasdaq, and he's asking if you're implying to go long on Dow and to short Nasdaq right now.
Sure. Yeah, let's get that back up. Yeah, look, that's what I'm looking at. That's something that because of this, it comes back to this trading regime. What sort of regime are we in, and where's the opportunity? So this is what I'm looking at, and I think it might be an opportunity. And certainly something I've been doing recently is, I feel more comfortable holding companies with strong balance sheets in this environment when we're getting that sort of tightening conditions, financial tightening conditions. And there's all sorts of indexes you can look at for an FCI, Financial Conditions Index, and we're getting this tightening. So when you have that tightening, these big, strong balance sheets, that's where I prefer to have risk, and I don't want to be in weak balance sheets. So yeah, so that's what I'm looking at. Be long Dow, short Nasdaq as a trade. So I mean, it's once again, risk management is crucial, and understanding what you're doing here is very important. I do it as a dollar match trade. So it's crucial to maintain discipline and risk management around these sorts of trades. But certainly that's what I'm looking at. Been long the Dow Jones and short the Nasdaq. Because of those reasons, there's strong balance sheet versus weak balance sheet. Now, of course, the Nasdaq's actually got some really good companies in there, but it's the peripheral which is, I think, potentially a problem for the Nasdaq. So, and look, indexes have all got survivor bias within them, and the fact that the Dow Jones is only 30 companies sort of lends more support to the strength of those balance sheets. So, essentially, any kind of index, it's S&P 500 or the Hang Seng or Nikkei 225, all these indexes, they're just made up of a number of companies, market cap. Most indexes anyway are market cap weighted. So that means that if you're the 225 in Japan, if you're the 226th largest market cap in Japan, but all of a sudden you have a period of expansion and you become the 224th largest market cap company in Japan, you move into the 225. And so that company that shrunk a little bit over that period, they've dropped down to 226, they're now out of the index. I'm simplifying here, but that is essentially how these indexes are calculated. So what that creates is survivor bias within equity markets. And so when the Dow Jones is only 30 companies, it's the 30 biggest companies in the US. So there's that strong balance sheet that I'm talking about. The 30 biggest companies in the US versus the 100 biggest technology companies. So there's a bit of exposure there. The top 30 Nasdaq companies would be fantastic because obviously Apple and Microsoft, like I mentioned, they're in there, and Amazon and all these companies with big balance sheets. But a lot of other companies in that index which do not have the capacity to fund themselves as well as the companies in the Dow Jones, in my opinion, anyway. So yeah, that's what I'm looking at. And as I said, it's just that vulnerability on the balance sheet. That's what we're really looking at here. So hopefully that answered your question.
Okay.
We have a few more there, Ethan.
Yes, we have a few more questions. So we have one from the crowd that's asking your view on oil supply risks, very affecting inflation. Do you have any view on that?
Yeah, oil is really interesting at the moment, isn't it? There's a lot of geopolitics playing out. We had the US, they drew down on their special reserves, and they sold at about $100, which was a pretty good move from the US government. And now they've indicated they'll buy again down at $70. So, oil has obviously plays into the energy. Natural gas is a big component there as well. Clearly, Europe have got a lot of problems with their energy supply. It looks like they're going to be fine for this winter, but there's a lot of focus now on the winter, going into the end of 2023. So that's where the concern is for Europe. The oil price, in terms of inflation impacts, look, it's really calmed down. In fact, I should have had this chart. I've got a really good chart on oil, which I could get up maybe later on, but we'll see. And it's about backwardation and contango. So it's a structural feature of the oil market. And what that does is that it tells you about the price difference between the futures contract, which is about to expire, and the futures contract that is expiring after that one. So when that front contract is above the second contract, that's backwardation. And what that indicates is, or potentially indicates, and certainly the market interprets it this way, is that means that buyers of oil are keen to take immediate delivery. Now, keep in mind the WTI, West Texas Intermediate, and the Brent contract are both deliverable. So that means that you have to have capacity to take delivery of that oil, the physical oil. So it's a physical delivery contract in the US. So if you don't have capacity to take delivery, you have to get out of your position. So what's happening when you have backwardation is that people are paying more to take immediate delivery. So that's what's happening with backwardation. We've been in backwardation for a long time, since it was actually before the war broke out. But only just a week and a half ago, we've actually gone into contango, which is the opposite of backwardation, and that's where the second contract is worth more than the front contract. So what's that? What is that telling us about the market? It means buyers aren't that needy to be able to take immediate delivery. They're prepared to wait. And so that's a really interesting dynamic in the oil market at the moment. And of course, OPEC Plus, they've stuck to their production cuts, although they struggle to make their quotas anyway. But nonetheless, they have tried to cut production. But look, it's oil has come back a long way. Supply chains really are redirecting. We're going through this huge upheaval because of the war in the Ukraine with the oil market. And in my opinion, it's just my opinion, it seems to me that Russian oil is probably going to end up in China, and oil from other parts of the world are going to end up where Russia used to supply, places like Europe, Northern Europe in particular, Western Europe. So it's just a realignment of where energy around the world is going to be redirected. And I think that's a big play in the energy sector, which has got a long way to go yet. Germany are talking about creating LNG facilities to be able to import LNG. Places like Australia export a lot of LNG, and so but you need to have the facilitation to be able to take delivery of those sorts of energy sources. The oil price itself, fantastic. I think it's really good dynamic for markets, really for broader economics, and hopefully that does play into lower inflation, because really we want to get inflation out of the system. The sooner inflation is out of the system, then the sooner we can get back to some kind of normality around policy settings, around investments, around trading. But at the moment, we've got this real problem, and the Fed is still trying to address it. So oil being down here, look, it's a great development. It's really a positive sign for inflation, and that may still play out, a fair bit. But once again, we've got this inflation in the system, and it's this entrenched inflation which is the real problem. Energy prices, oil's come off. I certainly know where I live here in Sydney, Australia. The price of petrol has come down, quite a bit, so that's been good. From a consumer point of view, someone who drives a car, but it's still high relative to where it was, say, 3 years ago. But it's nowhere near as what it was, not that long ago here. So, so hopefully that does impact. Hopefully that does help bring inflation down. That would be ideal, but we're not really seeing that yet. And oil's been down here for a little while now. It's not hasn't just crashed overnight, although it is lower again. But it's not having that big impact that it was having a little while ago, and energy prices are still very volatile, so so that's still a problem in the system here. So hopefully that will impact and bring inflation down. That would be ideal for all involved, really. Hopefully that answers your question around oil.
All right, so we have a few more questions for you, Daniel. So I think the next one, if you can take, is on the dollar index and Hang Seng. Does the dollar index impact Hang Seng? Is there a correlation, anything like that?
Yeah, look, that's a really good question. It's quite an in-depth question. Hang Seng made their high, I think, 2018, and it's obviously a long way from its peak back then. And look, I think it's actually one of those things where it is a nuanced market in China, and clearly the share prosperity policy is very significant. And it has played out really through the Hang Seng. And obviously the property sector in China is a big problem. There's a lot of domestic issues, which I think it is one of those markets that's not as impacted directly by the Fed as some other markets, because of obviously China's the world's second largest economy. They've got a very different policy path, not just on COVID, but on monetary policy and stimulus measures and how these things go about. It was interesting. I saw an interview during the week, and it was with one of the tech titans, and he was talking about the problem for. It was actually, I was a venture capital guy. That's right. I was talking with, and he's big in the tech sector, and his issue with sort of the Hang Seng Tech index in particular is the problem is that with the share prosperity policy, is that what the government's saying is that, yeah, sure, take the risk and set up a company, but you can't have mega profits. And for him as a venture capitalist, he goes into these tech companies because he'll invest in 10 companies, hopefully 1 or 2 of them go to the moon, and if the other 8 or 9 don't go anywhere, well, he's not too worried about that because he's got the 1 or 2 that make 20 or 30 or 50 times. But if the policy in China doesn't allow for those outsized profits, those jumbo profits from a tech company, then that's a problem for him as an investor. So that's just one little side note which I thought was interesting in the week that I'd share with you. So the Hang Seng has, but the point there is about the Hang Seng has all these unique dynamics that are unique to the Hang Seng, whereas say the Nikkei, the ASX 200, the FTSE, well, the FTSE's got its own little issues as well. But generally speaking, global equities, they're tracking pretty close, except for the Hang Seng, and it's because of those domestic policies, in my opinion, anyway, that they're having an impact. They're big policies, and they're trying to change the landscape there, which is that's obviously completely entitled to do, but it does have an impact for markets. And as I mentioned, for investors, when you're looking at where do you invest your money, all around the world, well, do you go to a place that inhibits jumbo profit? Unfortunately, that's how investors make assessments and make decisions and how they allocate their portfolios. Which part of the world? Well, do you want to go to a part of the world that encourages jumbo profits, or a part of the world that doesn't encourage jumbo profits? So, but that's more the tech side, obviously. But the property sector, there's a lot going on there. But we've seen this week, some of the rhetoric now coming out of government officials in China. There seems to be toning down a little bit there, the persistence on, taking out those, those big profit sort of companies, particularly in the property sector. I think Xi Jinping's comment a couple of years ago about, houses are made for living rather than, speculating. So some words to that effect. I'm probably doing a terrible interpretation of what he actually said there, but it was along those lines anyway. So they seem to be backing away from that a little bit from what I've been reading this week and the last couple of weeks. And so it'd be interesting to see how that plays out. So in terms of the dollar index impacting the Hang Seng, well, clearly, it's a tightening policy out of the US, which is feeding through the dollar honky and dollar yuan, obviously. So that does have a role to play in some way, but I think it's less direct than other equity markets, in my opinion, anyway. So
okay,
hopefully solve that one.
All right, so I think we can have time for 2 more questions. So I think we have one more from Robert. So he's asking, currently coal prices have been reaching new highs. So do you think it will continue to with this high prices next year as well into 2023?
Yeah, that's a really good point, because I was going to allude to that before with the oil question, but coal in particular, it's one of the most fungible energy assets. By fungible, I mean that if you can't get natural gas, coal is an energy source which is really easy to fire up a power station, a coal-fired power station. And so that's, but of course, in a world where we're trying to be more energy efficient and more green with our energy supply, that's not the desirable outcome for many governments. But it's a reality, and until we really solve the energy issue around emissions and all that sort of thing, then coal has a very important role to play, and that's why you're seeing this run up in coal prices. So until these facilitations I was talking about before, LNG and all, nuclear seems to be on the back burner at the moment. I spoke to a guy who works in this sector 2 weeks ago. I was at a seminar, and he's in this part of the market, and his point was that nuclear doesn't get the attention that it perhaps should if you want to go to clean energy. And part of his view, and it was interesting, it was an interesting take, is that with nuclear is that the power stations that have had problems were built in the 1940s and 1950s. So would you drive around in a car that was built in 1955? Probably not. I wouldn't, I don't think, because the safety features on that car versus a car built recently is huge. And his point was the same about nuclear power stations. So I thought it was an interesting angle on power station. And he also talked about micro nuclear, which is very small, but very small nuclear stations, power stations that can be built. And so rather than having the large sort of facilities, you have a series of smaller ones, and obviously that's a safety issue there as well. So, and that's interesting. So, but back to coal though, yeah, look, I can't predict coal. I don't trade coal. But when you look at the energy market and you look at coal being that fungible replacement for high cost natural gas, which is hard to move around the world versus coal, which is easy to put on a ship and get to wherever you need to go. So, obviously it depends on the grade of coal as well, but certainly, it looks like to me that there's that underlying demand which doesn't look to be going away anytime soon. But I haven't looked at the coal market that closely, to be honest.
All right.
Hopefully that provided some feedback for you anyway.
Yep. Thanks for the answer, Daniel. So I think we can take one last question before we pass it on to our next speaker. So I think since we have a lot of Australian viewers, right, maybe you can share, how is we have a question on how is the inflation in Australia different to US?
Yeah, look, it's interesting, and I wrote a piece today, actually. I just published about an hour before I came on here, and it talks a little bit about the RBA and what they're trying to do with inflation. And look, the RBA have got there's a lot of domestic pressure on the RBA here, whereas the Fed has been able to really front load their rate hikes, and because of they had the Volcker solution, and I think the US is more familiar with trying to deal with that inflation problem than perhaps in Australia, and the RBA has actually copped a lot of flack, and certainly, I can understand that because, people who have borrowed, to do all sorts of things are facing higher interest rate costs, and, that's not good, but it's being done for a reason. And, they're talking about 8% for this quarter, the year-on-year number. So 8% is a long way above the 2 to 3% target that they have. So, look, there's a lot of fixed rate loans that are going to start rolling off next year. And I think the RBA, that's why they've been a bit cautious about going too hard. Not just the pressures that they're facing domestically, but also that, they know that the mortgage problem here in Australia is more pronounced probably than other parts of the world. So in terms of the 8% inflation that they're expecting for this quarter, that's high, it's uncomfortable. But there's also, there's a lot of people who are not very happy with that, the rate increases that we've had. And until we get those price pressures easing. And the big problem here in Australia too with inflation is that there's a lot of enterprise agreements that continue to roll off every month. And by that, I mean those wage increases that I was referring to earlier in the seminar. But that, this is a real problem for the RBA because they've got mortgage belt, really screaming up, but they've got wage increases coming through. And so on the one hand, they've got one part of the economy, slowing down, the other part of the economy is accelerating. And that's a problem. When you get 8%, a lot of these enterprise agreements, they're based on inflation. That means 8% pay rise. If you're rolling out, if we get 8% in the third quarter and your review is in January, people are getting 8% pay rises. I mean, that's huge. So that's a problem. And the RBA are aware of that too. So, look, I think what the Fed did well was that they jacked up rates really quickly, really abruptly. And I think that the RBA would have liked to have done that, but I think there's a lot of pressure here domestically. And also, look, in the reality too for the RBA, and it is a different dynamic compared to the US, is that in Australia, it's quite a, monetary policy generally is a bit of a blunt tool, and there's a long lead lag effect between monetary policy changes. But certainly when you get aggressive change like we've had, they tend to, they go through the system pretty quick. And that here in Australia in particular, there's a lot of sensitivity to mortgage debt. So it is actually a sharper instrument here in Australia than it is in other parts of the world. And that could also play into why the RBA sort of pulled back on their aggressive hiking. So, inflation, still a problem. I think the ASX is actually probably a preferred part of the world when you look around. I mean, I might be a bit biased there, but certainly, unfortunately, that war in the Ukraine has, the human cost cannot be underestimated there, and it's a terrible situation. But in terms of the economy, for the ASX 200, Russia is the 8th largest economy in the world. Australia and Russia, it's only accounts for trade between the two countries, only accounts for 0.3% of all of Australia's trade. Russia is the 8th largest economy. I mean, that's just crazy. But the reason for it is because Russia and Australia compete on the same exports mostly. So wheat, copper, gold, iron ore. They've even got some iron ore, although the iron ore is actually in the Ukraine. There's some theories around the reasons for the invasion of Ukraine. There's lots of theories, but one of them is that they do have iron ore deposits there too. So, but also obviously natural gas and oil. Russia is big exporters of that energy source. We export LNG as well. So we compete with Russia on many different commodities, and so the trade surplus we've had up during the week, it's just massive, and that's just rolling in every week to every Australian every Australian exporter. So $12 billion, the last one, it's just, that's a huge amount that's coming into the local economy. The current account came out during the week as well. It was a slight negative. The reason it was negative is because the big miners got such massive dividends that they had to pay their offshore investors. So the only reason the current account deficit was a deficit was because the boom that they've had in commodities. So, you know, it's the dividend season just gone through. So that's why that was a current account deficit. So the trade surplus is big. Inflation is still here in Australia. The RBA, I think that, you know, they don't meet until February. They raise rates during the week just by 25 basis points. They won't meet until the first week of February now. So they've got 2 months to let that flow through. So, you know, that's what they're up to. And, you know, the problem also is inflation here. We don't have a very good read. They had a monthly read came out during the week, or the week before, sorry. And it was a little, you know, softer than expected, just under 7%. So that was good, but it's only a monthly number. And, you know, that's the first time they've produced a monthly number. Normally it's quarterly number, and we won't get that quarterly number until just before the March meeting, I think it is. So I'll have to check on that. But yeah, so it's a long way off before we get the official quarterly read on inflation. But ideally, that comes off a little bit. I hope that answered that question about the ASX 200.
All right, Daniel, terrific Q&A session. Thanks a lot for your wonderful insights once again.